This session is called Which Trade Barriers Matter for the UK? So I'm joined by an esteemed panel. First we have Swati Dhingra, who is the research leader of UK in A Changing Europe and also assistant professor of economics at the London School of Economics. Then we're going to hear from Martin Donnelly, who was formerly permanent secretary at the Department for International Trade, but is no longer a spokesman, does not speak for the Department for International Trade anymore. I'm sure he'll be grateful for me adding that caveat. He was part of setting that up. So clearly, once, when Britain was in the EU, certain, trade strategy was delegated there, and now the UK is having to think about trade policy with respect to non-EU countries much more, so hopefully we'll hear about that. And then finally we'll hear from Sam Lowe, who leads policy and campaigning work on trade and Brexit for Friends of the Earth. Okay, so before allowing each of the speakers to talk for around 5 minutes and then opening up to questions from you, I thought I'd just kind of do a dummy's guide to trade barriers. So there are sort of, economics trade barriers that it's hard to overcome. If countries are far away, then that's a problem. If they speak a different language, that's also a problem. If they're poor, they don't really want to buy your stuff. Then we have tariff barriers, quotas, tariff rate quotas. Then we have regulatory barriers. Either something isn't allowed in at all, or maybe there are just different standards. So maybe you have to have two different production lines, one meeting each set of standards. You have customs checks, so barriers at the border. You have just, in lack of information about what export and import opportunities there are. Those can be really important barriers to trade. And I think overall one should be really careful in distinguishing which of these simply raise the costs of doing trade and which just block trade entirely. So certainly in some financial services, you could think that there would be some kinds of trade barriers where it would be a sort of trade deal says no sort of thing. And maybe we should worry differently about the different kinds. Okay, so over to Swati. So 5 minutes, I will be ruthless.
Great. I can't help but spend 30 seconds saying this is the worst topic to speak on. There's absolutely very limited data, and the sort of task you're asking people to do is to figure out every regulation that the EU has and how that might change. So that's a momentous task which I don't have an answer for. And I think it's actually Anand feeling jealous that the last 2 weeks I was in India and I need to be punished and be given this topic to do. So moving on from there, the tariffs, non-tariff barriers, and behind-the-border policy measures is what you should be thinking when you think of trade barriers. How about tariffs? Well, we've all heard enough about WTO, MFN tariffs. So I'm just going to say at the moment, if you look at EU-US tariffs, the average tariff rate is about 1.5%. Not such a big deal. Of course, really important for some sectors like the auto industry, where the cars could end up with a 10% tariff when they're shipped to the EU and back and forth. And remember, car parts cross borders about 40 times even. So we're talking about these massive cascading effects coming from tariffs. But most people think that generally getting a free trade agreement is much easier than trying to do something which is going to replicate some of the features of the single market, that we have the same set of rules and regulations, which means we don't have to go through customs checks, we don't have to go through other border checks to check whether products actually comply with certain safety regulations that the EU has. And finally, what about what happens when our regulations start to diverge from the EU? So even though we might be exactly equivalent to the EU at the moment, what happens tomorrow is the question. And more importantly, what happens when we actually disagree with the EU? We don't agree on the same issue. Right now, we go through the European Court of Justice to resolve those disputes. Once you're out of the European Court of Justice, where do those disputes go? So these are some of the non-tariff barriers. And if I wanted to give you sort of a ballpark number for what that means, if the tariff is 1.5%, and if I try to put a similar number on the non-tariff barriers, which are all of these various border checks, customs checks, dispute settlement issues, that number would be about 20%. So that, in fact, is the big deal, because that's really, really hard to resolve without having regulatory agents talking to each other, which is generally very difficult, and that's what the EU accomplishes. So in that sense, let me get to sort of one final thing, that these are all ballpark numbers. In fact, what we're learning as there are more sort of specific sectoral details coming out, and I mean now much more broadly the general literature, what people are reporting in magazines, newspapers, everything, what we're hearing is that the numbers are probably worse. There are a lot of unknown, to use the cliche from Donald Rumsfeld, there are a lot of known unknowns. So just to give you an example, the European Chemical Agency, thanks to Anand's tweet about this, that what they've recently sort of acknowledged is that 6,000 chemicals, which currently under EU registration, are going to sort of cease to exist. So what that means for the chemical industry, even though it's a manufacturing good, you would have thought tariffs are really the most important thing. It's actually these non-tariff barriers that are going to raise their head over and over again. And that's really what I think are the most important trade barriers that we have to put up with.
Wonderful. Okay, great. Well, under time. So, Martin.
Thanks. Well, following on from Swati's very clear comments and that excellent last discussion, just stepping back, first of all, the exam question is what trade barriers matter for the UK? Well, why does trade matter? Because we are trying to add value in a global economy. We're not doing trade for the sake of it. Trade comes out of competitiveness and therefore links with productivity. And I think it's worth reminding ourselves of that because imports are just as important in our competitiveness as exports. So we mustn't put trade in a separate box. Secondly, the UK doesn't trade. Companies, firms, individuals trade. And I just want to expand a little bit on that point and then talk a bit about where government most affects that competitive environment within which we seek to add value. We've talked about the economic framework, just moving it down to individuals. I think about 320,000 traders are registered with our authorities, and more than half of those only trade with the European Union. Now, some of us, including me, are old enough to remember when trade with the European Union required a significant bureaucratic apparatus, which was actually physically dismantled at the end of 1992. You didn't have to stop and go through the various agents at Dover and elsewhere to get your stuff done. If we move away from that, and assuming that we do, then one car company, and it's a good example of an integrated supply chain, you're talking about something like 15,000 rules of origin certificates. Okay? Those are likely to come in at about £15 a throw. Maybe you'll get a discount if you're doing a lot of them, maybe you won't, because it's a labour-intensive process. So there is a cost element there. But more importantly is the delay element. If you are competing, and much of our trade and much of our recent investment has come from companies who are building integrated supply chains, either intra-company or with a very close-knit group of long-term suppliers who they trust to develop the next generation, not just of hardware, but increasingly of digital software as well. Those companies need to be certain that they can deliver in time with products about which there is no legal or consumer question. So it's not simply a matter of price, it's also a matter of speed and certainty. If you look at supermarkets, I think there's been an estimate that they would need about 80,000 import declarations every year. And the cost of one of those for a large business is about £25. Smaller business might be £50. You could do it through intermediaries, and they might charge you between £10 and £40. Now, these are ballpark figures, but you get an idea of the cost. It's not necessarily massive, it is not irrelevant, and it is a considerable additional layer of complexity. The number of customs declarations probably goes up from about 50 million to 250 million or more. That raises obvious issues about managing that process digitally or in any other way, which I don't need to go on about. And then you're adding estimates around £4 to £5 billion worth of administrative costs to UK traders overall. That affects competitiveness. So we've got a lot of very complex issues. Before we come on to questions like data sharing, and how far can you move data across borders? Security declarations for the 17% of UK goods trade that passes through Dover. This is a real issue. You have to give about somewhere between 1 and 24 hours of notice if you're moving goods through. And of course, some of those goods have to be checked for obvious security. even assuming you're not having to check them for compatibility with EU regulations. So the customs union element and the internal market element come together in competitiveness. Just very briefly, to make a quick point about the most important government departments. Let's just mention innovation. What do innovators require for startups or scale-ups? Essentially, they require access to data, so you must be within a data regime where you can move data around, know you've got legal protection, know that you can deal with consumers. They also need access to people. And you need to know that you can get hold of the people rapidly, and you want a large people market, which of course we have within the European Union, which is why a lot of French, Italian, and indeed some German startups come to the UK. That means that one of the most important departments going forward is the Home Office, because providing certainty of access to people will be a key choice, which people deciding where they want to be competitive are going to have to make. Department of Culture, Media and Sport is going to have to look at the issues around data protection, access to data, certainty that we will be allowed to exchange data freely within the EU, which will require following EU rules. And then you've got the wider competition environment, which will be controlled by the BEIS department, and what are we doing about state aids and competition policy. All of those things are the most important issues around trade barriers. I think, trade defense rules, that's fine, but it's marginal. We are competing in a global marketplace, and these are the key issues that will determine companies' decisions on investments and traders' decisions on where they want to situate themselves and where they want to pay taxes.
Thank you very much. Sam.
Yeah, thank you for having me. I think I'm the token hippie for the day. And you might be wondering why I'm talking, but as well as working on trade, I seem to have developed a side career of explaining cumulative rules of origin to the good people of Twitter. And I worked on trade in an environmental context for a while before Brexit. And when it comes to this idea of what trade barriers matter for the UK, I like to sort of think of it in terms of choices, because in reality the UK is not going to completely go it alone on regulation. We're not big enough. We don't get to set those rules globally, but we do probably have a choice. We either continue to conform, broadly speaking, with the EU's approach from a regulatory and standards approach, or maybe over time we sort of pivot. There's some sort of transatlantic pivot, and we move closer to the US approach. And the reason I say about this, I sort of think of the world in terms of trade and in regulatory issues and standards in terms of there being two superpowers. You've essentially got the EU and US, and you've got a third on the rise in China. But China's not quite there yet, although it's starting to export its standards through its Belt and Road Initiative. But so the UK's in this position where essentially we're going to have to choose. We're not a big enough market to dictate these rules ourselves. If we want to completely have our own approach, we don't buy enough from everyone else to export it globally. We're going to still be a follower, but what we do is have a choice. And I think the thing that hasn't been fully acknowledged is that the UK is in a situation where even desiring the flexibility to choose to diverge from the EU model will result in new non-tariff barriers for UK exporters to the EU, and even very minor issues can have big consequences. And yes, I'm going to use the chicken example now. So it's been in the news a lot. It was in over the summer, and then Michael Gove and Liam Fox had an argument about it yesterday from across select committees. But the issue with chlorinated chicken, as it's known, isn't in regards to Brexit. Is it safe or not? It's what does having the ability to diverge from the EU sanitary and phytosanitary framework mean in regards to the UK's future relationship with the European Union. And the EU's approach to SPS, food and plant hygiene issues, is quite firm. Either you're fully harmonised, including for imports from third countries, or your exports to them have to go via a certified border inspection post. Calais isn't currently a border inspection post. The Irish border does not currently have border inspection posts on it. So even desiring the flexibility to diverge in order to strike an agreement with the US and accept a product that maybe Liam Fox doesn't have an issue with has knock-on consequences that are far bigger than the small little issue we're discussing. And I think what it comes down to is, everyone else has been brief, so I'm not going to go with my other example, but there are trade-offs. And there's no economic reason for divergence from the EU model that I can see. There's no benefit that really comes from it. There's no, from an environmental perspective, there's no environmental reason to diverge in how we approach standards and general regulatory issues from our nearest neighbour with whom we share a sea border and a land border. But there is maybe a political reason, and on this, is how much divergence is necessary to satisfy the shifting mandate of Brexit? And I'm not sure we know the answer to that. But there are questions. Is the ability to import chicken that's had an antimicrobial wash used on it from the US worth border inspection posts on the Irish border? That's an actual trade-off that will need to be worked out and decided on. And we're in this period of political price discovery, and I worry that many aren't factoring in the broader consequences of their actions, of their offhand comments, of their desire to do more with the US. Because the fact is that I actually think, in terms of to have a deep relationship with the US, for example, as the other regulatory superpower, it requires divergence from the EU regulatory model. And I think we were talking about the economics earlier. If you look at that on aggregate, I don't actually see a deep relationship with the US at this moment being a net positive, because as barriers with the US go down, they will have to go up with the EU. And when you weigh that up, I don't really see it. I mean, the TTIP estimates of an EU-US agreement was, by 2027, an increase of 0.35% relative to what it would have been earlier. That's a lot less than what we were discussing earlier. And it also doesn't take into account, it was the TTIP model, so actually when the EU as a whole reduced regulatory barriers, it didn't create it between each other. If the UK was to go that alone, actually there's a trade diversion issue. So, yeah, we have choices when it comes to standards and trade barriers, but I feel that we're still sort of in the fun stage of it, where we just get to talk about fun issues like chicken without actually considering the knock-on implications and what that means.
Thank you. I want to use my privilege as chair to ask a follow-up question. So we've talked about chemicals and rules of origin and customs checks. We haven't really talked much about services, which obviously are kind of 40% of exports to the EU. Swati, maybe could you begin by commenting on how the trade barriers matter there?
So let me start with an example, and then I'll try to quantify as best as we can. So in terms of sort of examples, if you want to think about EasyJet, one of the restrictions that's there in air transport is that you have to have a European headquarter if you're going to be flying airplanes in the European airspace. So EasyJet has set up an office in Vienna. A lot of the numbers that we were talking about in terms of trying to estimate the impacts of Brexit, we haven't been able to take into account all of these various regulations that would affect foreign investment, that would affect where firms locate. So there are massive, massive issues here, and I think we've only been able to get at a much sort of smaller aspect of it, which is how much would be the increase, how much would be the reduction in trade and services, not really got even to the heart of what the foreign investment numbers would look like. And if you were to sort of get a ballpark estimate of how foreign investment could be affected, you can think of what EFTA membership did to foreign investment as opposed to EU membership. And even that difference would tell you that foreign investment you would expect would fall about 20%. Now, of course, that doesn't mean everything that's in the UK at the moment is suddenly going to flee to Europe, but it does give a sort of idea of the negative impacts that are possible. In terms of if you really wanted to quantify what various clauses in different trade agreements do, so this is totally fresh off the press estimates, which is if you look at domestic value added in goods trade, what a good trade agreement does is to increase that because it reduces trade barriers. What particular clauses do to a trade agreement is increase it even further. And in the case of goods trade, you would say that, well, if the number is 17% is the typical impact of a trade agreement, you get another 12% boost coming just from having these much deeper clauses built into that trade agreement. If you look at the same number for services, that number is going to be, first of all, that it's about a 72% increase in services trade coming when you do sign these trade agreements. And if you want to look at the particular clauses, which are services, investment, and competition related, then that number, the fraction that's coming, the boost that's coming from there is about 42%. So much bigger impacts on services trade when you have these deep clauses built in, and much less in the domestic value added on goods, which is what we typically think of when we're thinking of exports and imports. So in that sense, services trade is really what I think the bigger impacts there would be, and there we don't know the extent to which the regulations sort of can be even more disruptive.
Can I also build on that? I think it is a fundamental point, and it's a good example of where this isn't necessarily linear, but you can have discontinuities. We don't have, as we know, a full services internal market with the European Union. We have a massively deeper one than with anyone else in the world now, or than any other trade deal is realistically likely to offer. And this really matters because it can be binary. So we've heard about insurance companies recently in the news wondering about the precise legal framework within which their policies and their assets are being measured. Another good example is legal services. We have about 3 billion net export surplus in legal services. There's a whole set of areas around arbitration, establishment, client representation, appearing before European courts, defending third country clients. All that could go. It would just not be there anymore if UK lawyers were no longer recognized to work across Europe. And that is the outcome that will occur unless we negotiate something different. So in the service sector, you've got these big sectors which can be massively affected, others that may not be affected much at all. And just finally, the point that was touched on in the previous discussion, manufacturing and services are increasingly intertwined. So Mercedes, for example, do more and more real-time checking of what's going on in their cars as they drive around, using all the software which we increasingly have in our cars. That software works across borders at the moment, and they expect it to work in a European space. If we don't find ourselves in that space, using the regulatory and ultimately European Court of Justice structures, what happens?
Sam, no?
I'm okay with it. I think
You're
I've
okay.
covered it.
Okay, wonderful. Can I take some questions from the audience? Yep. Should we take a couple? So, and the gentleman behind as well.
Anastasia Belyakova, British Chambers of Commerce. I agree with Sam about the US and the EU being the two big standard superpowers in the world now. I guess a slightly glib question, but just trying to be a bit provoking and stimulating debate. Why would we have to choose? Why can we just have our cake and eat it too? Have full alignment with the EU on veterinary checks, but then pick and choose other sectors where we would like to be more friendly with the US. What are the actual technical reasons or reasons of integration of various sectors why this would not be possible?
Thank you. And the gentleman behind.
Dilip Shah, regulations and standards were talked about, but we know that not all regulations and standards are set at the EU level. So I'd like some kind of breakdown, if anyone has it, in terms of proportions. What standards are set kind of internationally or at the sort of WTO level? What are Europe-wide standards? So there are some standard-setting bodies which are wider than the EU, and then what proportion is roughly set by the EU itself? Thank you.
Thank you.
Standard. So you didn't give me any specific sectors, so I'm just going to take liberties slightly. But in terms of, say, the actual standard-setting machinery within Europe, you've got the three standard-setting bodies of CEN, CENELEC, and I always forget the third one, so I turn to a page, ETSI, which broadly set standards for the entire European area beyond the EU in terms of the 33. It covers about 34 countries, but includes Turkey, for example. So it's not entirely in the EU body. It's a private body, but they essentially collectively set and decide on what standards will be applied, and the European Commission also sometimes commissions them essentially to set standards as part of different regulatory approaches. So I suppose the question then is, the UK afterwards, could we accept European standards as set by this body and say also the US? And there's some trade-offs involved essentially. If we wanted, we're in a one standard setting model within Europe. So if we wanted to, say, accept US standards as equivalent to ours so that they could be sold in to the UK, and I'm not talking about conformity assessment or anything like that, I'm talking about purely accepting them as equivalent. First, you have an issue in that they've got about 700 standard setting bodies in the US, which makes it a bit difficult. But also because we would have to leave the European standards bodies, and that's a big sacrifice to make to be able to do that, because it encompasses our biggest trading partner, essentially, and I think UK industry accounts chairs about 28% of their committees. And it also is a large exporting body. I think I read an interview with the CEO of SEN recently, and she said a total of 87,696 European standards are now effectively adopted in third countries. So to not be a part of that process anymore is a big sacrifice. And then we go to a situation where, okay, we've lost that influence, but we can accept European standards in the UK as fine and US standards. You have an issue there with the US that conforming to a US standard doesn't actually necessarily grant your product access to the US. That's not the same with the EU. If you've got the CE stamp, you're okay, and it's because of the range of conformity assessments. So you can have a model for the UK where you accept from both, say, and treat them as equivalent, but you lose a lot of influence along the way, and in other areas like chemicals, it's just not possible.
Aren't there some more philosophical differences in terms of positive and negative lists? Could you explain that?
Well, there's philosophical differences in regards to precaution, which I think is actually the big philosophical difference. And this is something to say, it's not true, I think, to entirely say that the US doesn't follow the precautionary principle. It absolutely does in some areas. I mean, there's a reason you can't buy Kinder eggs in the US.
Explain the difference, maybe.
So precautionary principle allows you to take action on a product, essentially, if there's suspicion of harm before there's been full proof. And largely in terms of practice, it puts the burden of proof on the manufacturer rather than the regulator. So the regulator doesn't have to prove it's dangerous to ban it. It's then left to the company to prove it's safe. It's a lot more detailed than that, but that's roughly how it approaches. And the US and EU in areas have quite different approaches. For one, in terms of SPS, which I seem to like talking about, the EU probably has an SPS plus approach relative to the WTO sort of baseline on SPS, and the US has a minus approach when it comes to precaution. The US writes precaution out of its SPS chapters. The EU relies on it in order to uphold bans that are disagreed with worldwide around approach to chicken and also the use of hormones in beef. So TTIP in and of itself could have been seen as an attempt to reconcile these approaches in order to present a united front in respect to China and the rising sort of standard setting model there. But essentially, I mean, there's lots of protests, but it would probably have failed anyway, insofar as the approaches are so different. And the infrastructure over decades created in such different ways that it was probably always going to be a sort of lost cause.
Thank you. So I think there's a lot of talk of regulatory equivalence, right? And that's the model going forward. We've just had some examples from Sam about how that's not the way that things are going to go. But would either of you care to comment on that? And I'd also ask the second question answer the second question of can we say anything about which standards are set where, and how important is the EU really, and aren't lots of standards set at the WTO?
So in terms of sort of what standards are set at the WTO and what are set internally, pretty much every modern trade agreement that you would look at is going to have a lot more coverage for services trade, for various kinds of dispute settlements, for things like who is able to procure for government contracts. All of those various other clauses are what is going to go into a regional trade agreement, and the general sort of message to take away from when people have looked at the differences across these two kinds of agreements is that overwhelmingly regional trade agreements tend to be much deeper than what the WTO has been able to achieve. So the WTO is trying different approaches, like having plurilateral agreements where you can sort of opt into membership and then, giving you sort of access to more members, but typically the clauses going in are much more restrictive. And even the sort of deepest trade agreement that we know outside of the single market, which is the sort of EU-Canadian trade agreement that was recently negotiated. So there's a lot of stuff in there which is mutual recognition and recognizing each other's regulations. But if you look at the actual services chapter, there are a lot of exclusions from that trade agreement. And that's what currently the UK doesn't have. So even if so one sort of example is financial passporting. At the end of the day, even if sort of financial passporting doesn't come into play and it's something like some kind of regulatory equivalence, there's still that question later about, is that going to cover commercial banking? Is that in fact going to, who eventually is going to judge when the next financial crisis happens in terms of who should be monitoring the Bank of England, who should be doing something at the sort of ECB level, how are these two bodies going to talk to each other? That's really where the problem arises. It's the fact that you don't have the certainty of which institution to turn to and what to do in the event of a divergence or in the event of some kind of big economic shock. And that's really what a single market does. It creates that free trade area into a single market where you have the same set of institutions.
And just to, again, just to hammer home that point, because it is so fundamental. More and more of our value added is through what we loosely define as services. But service provision requires a clarity of structure about what the service is, about who is providing it, and about what the dispute resolution mechanism is if you're not getting what you want, which in turn, unless you go for a sort of best endeavors and regulators will talk to each other approach, which has its place, but does not provide the same level of certainty as a legal structure as we have in the European Union for those service sectors which we are dealing with together. And when businesses come to choose where they invest or where they want to add value, it's the legal certainty which they are looking for, because they can't afford not to have it if someone else is offering it and we're not.
More questions?
As you pointed out, Martin, it's companies and traders who trade. Can you say something, you or any of the others, about the barriers that are important to different sizes of company as opposed to different industries? Will it be, you mentioned using agencies, this presumably has a cost. Would you expect trade to become even more concentrated among large firms, or do you think it will become completely delegated to agencies?
Well, I think that's a good question. I'll be interested in my colleagues' views. I can see two potential things happening. As I guess we all know, one of the UK's problems has been that not enough companies trade. And the companies that do trade improve their competitiveness because they are in a more challenging environment. What we will be doing for small companies is making it harder, not easier, to trade, because at the end of this process, there will be more barriers. The only question is how many more and precisely where they are. I mean, that's what we are in the business of doing. So that is not a good thing for small companies. On the other hand, very large companies do not want the extra hassle and cost. And we know, and it's not just the automotive sector, it's most advanced manufacturing now, boards will sit down and look at proposals from several countries in Europe and probably several around the world. If the UK is constantly having to add not just a cost, but a time uncertainty element to this, it will be a significant factor in future investment decisions, which won't be to our advantage, and therefore there will be less intra-company trade, other things being equal.
I'm going to just appeal to sort of historical evidence, which is that typically when you see higher trade costs, it's going to be the bigger firms who are going to be able to export. And that's just generally true across different countries, different time periods, different sorts of trade cost measurements. So in that sense, one would expect that, in fact, the smaller firms, which do currently sort of rely more heavily on exporting to the EU, are probably going to be much more constrained. But what other effects are going to play out in terms of many of these smaller companies rely on EU funding for, say, government contracts, for various other linkages? Those, I think, we have much less information on how that's going to play out.
So I'm quite interested that it took quite a long time to get to financial passporting, given that it's actually, by value added, probably our leading export sector. But so, bearing in mind that financial and business services are, by value added, our biggest export sectors, what would be your wish list, your top 3 for a trade agreement with the EU?
Thank you very much. Who wants to go first? Sam? And the answer can't be stay in the EU. That's not allowed.
Have a think about it.
I think I'd like to not quite answer the question because I don't have enough technical data, and also the definition of what falls into asset management, what falls into derivatives trading and so on can be quite technical. I think there is a fundamental question though for us as to how far in sectors like financial but also professional and business services, law, accounting and so on, and obviously all the issues around data and data protection, we are prepared to buy into a European structure in order to continue doing business, which we will no longer be able to influence, and where we will have to accept some system of ultimately judicial control over whether or not the products and services are consistent with the regulations. And I think there is a prior question for government about what its answer to those questions is before we can go down to the individual sectors, though I think we do need to do that too.
So the operational word in what you asked was wish list, and my wish list is probably stay in the single market and continue the efforts that the DIT and before that actually the Treasury had already been doing in trying to essentially get developing countries to open up markets for services. That, I think, is the most productive way to go, and that's something you don't necessarily have to get out of the customs union to do. The Treasury already did that with trying to get India to open up its legal services market, now talking about financial services. So those are much more lucrative avenues to pursue than just sort of, having this debate about should we get out of the customs union or not.
I mean, on financial services, I just like to point to the difficulty that there is going to be in actually having passporting or essentially focusing on mode one, so specifically cross-border sales, insofar as there's no precedent for it in the EU's existing arrangements. And they have, as it was in the paper yesterday, they do have, in regards to at least Korea and the Canadian agreement, most favoured nation provisions, which most favoured nation means nothing to anyone because it's constantly used in different ways and it's used differently in this sense than it does to the WTO. It's essentially a provision that says, if other people get it, I want it too, in the context of these agreements. And the Korean specifically on services, where if there was further mode one liberalisation, so mode one being able to sell across a border from within the country that you sit, on financial services or banking, they would want it too. And that creates a problem. And there are caveats to these clauses, because otherwise the EEA wouldn't exist, for example, or Switzerland wouldn't exist. So, and they're largely to do with degrees of regulatory alignment. But there is a problem there, and I've had people say to me, oh, but Ukraine has it, because if you read the schedules, it sort of looks like Ukraine does. But then you go to the member states' reservations, and on mode one and banking, it's UK unbound, Germany unbound. It's not there, and there's no precedent. So outside of an EEA-type framework, it's difficult to see how this can exist. And I think there's obviously some companies are starting to make choices on the basis of that already.
I have another question, if I may, which is to ask about how the movement of labour features as a trade barrier. So if we leave the EU and that imposes, maybe we need to get visas, or there are frictions introduced in terms of people not being able to work in the UK from the EU, how does that show up in terms of a trade cost? Or not? Yeah.
I think this is actually going to be a fundamental issue for the UK. If we take the research and university sector, there's the whole issue of will students want to continue to come to the UK when they have other choices if they cannot stay either to work or to do doctorate and then postdoc research below a certain salary threshold, which may be not the salary threshold set by the Home Office. So you get to a level of complexity, and then second-order issues for bright, well-qualified people. There is a global market. And if it is more difficult to come with your family or other close friends or team workers, then that is a major competitive disadvantage. Similarly, if the bureaucratic process requires someone to be a student and then to go back home and then reapply for a visa to come back to the UK, and other countries do not have that process, that is a major stumbling block, and that will affect the quality of research and innovation and so on. The other example I just use is the other way round. And you may want to comment on this, Swati, but we have had with India's negotiations with the European Union issues about how many visas there will be for software engineers, among others. And one of the key asks for the UK will be, well, how many visas are you going to give for people in these sectors to come and work in your economy? And that obviously raises a set of issues as well. And I think the final point I'd make is, if the UK starts to become less competitive, we will find more UK talent moving abroad. That's what's happened into the UK in many sectors, pharmaceutical being a good one, life sciences, in recent years. There is no reason why that process only works in one direction, and it's very hard to reverse.
I was going to talk about India and Mode 4, but it's been covered. Yes.
I'll give the Indian perspective on Mode 4. So, several ministers within the Indian government have already made a very explicit statement that they think that the UK's sort of reluctance to give visas to Indians is an anti-Indian stance. Mobility is key, and without that, they just don't see the big gains that are there in the agreement. And there is some truth to that on both sides, that yes, you don't want to undercut wages by letting Indian companies do intra-company transfers, by paying lower wages to these Indian employees, but at the same time, from India's perspective, what do they have to gain? If they're going to open up sort of controversial sectors like the financial services industry, they want something in return. There has to be a sort of give and take in any negotiation. In terms of sort of how binding these issues are going to be, which is how we started this conversation, I hate giving personal examples, but I will, because I think that's really pertinent to highlighting what that sort of margin we're looking at, is that when I applied to PhDs in the UK as well as in the US, I essentially decided not to apply at all in the UK for the reason that the form was 50 pages, no financial support forthcoming in any easy way. And in the US, it's just extremely easy to do that. So of course, why would you bother wasting your time with the UK? You would just go apply to the US, which is just as good, or probably some would say even sort of more varied. So those are the sort of constraints which are going to come into place.
But I would say as well that Mode 4 is not just an issue with India. It nearly scuppered the CETA negotiations with Canada. Australia are going to ask for it too. And maybe there's a line of thought, you sort of hear these sort of Kanzak arguments from certain constituents in the UK, if we're going to have some prosperity zone with Canada, New Zealand and Australia, where we'll have free movement between the whole lot. Is that okay? Is UK politics comfortable with that? The movement of people and trade is becoming a much, much bigger issue. I mean, it's still one of the big constraining effects on supply chains, right? So you can do them across the world because goods are now pretty easy to ship. You can do the IT system globally, but how do you move your manager about? How do you move your people around it? One, it's still takes a long time to fly there. We haven't invented teleporters yet, but also the difficulty of getting visas. So it's going to continue to rise as an issue, and I'm not sure the UK is in the right place politically to deal with it.
More questions?
Yep, gentleman there.
Alan Winters from the UK Trade Policy Observatory. It's more of an observation, but I guess I invite the panel to reflect on it. The more I've thought about it, the more I've listened this afternoon, becomes increasingly evident that the real contribution of the single market is the sort of infrastructural stuff rather than the sector-specific stuff. It's essentially not something that you can replicate sector by sector. The minute you start to do services agreements sector by sector, the whole question of definition, is it in this sector, is it in that sector? The whole question of uncertainty about in the future, if something changes, is sort of a positive-negative list. So I've begun to think that the real contribution that the single market has made to trade within Europe is essentially a common labour market, a common legal system to which private individuals have access, probably the common data infrastructure as well. And that in some sense we are rather missing the boat if we think that we can reconstruct it, this sector by sector, however many sectors are we going to have to construct, and even then, where will we identify the boundaries?
Thank you. There was a gentleman over there.
Thanks. Ian Begg, also from LSE. I want to sum up in one way, which is in the last two sessions, the gist of the messages has been, yes, let's try to keep the single market. But that then poses a much more political question, which is, if we say we want to keep the single market, isn't it, in essence, betraying the Brexit vote from our perspective? Because Brexiteers want to be outside the single market, they want to restrict free movement and so on. But perhaps more pointedly, isn't it also betraying the EU side, who don't want Boris Johnson's having your cake and eating it, and don't want to encourage a context in which some countries can benefit from all the advantages of a single market without paying any of the costs? Moreover, just being in the single market won't satisfy pro-Remainers. So in short, it's a position in the middle with which nobody is comfortable. What would your comment be on that?
Swati, would you like to begin?
Yes. I mean, Alan pointed out this really important fact that what the single market has done is create institutions, and the sector by sector analysis sort of is never going to be able to tell you what that sort of sum of all these little parts is delivering. I mean, I think that that's perfectly right in terms of sort of why we bother doing sector by sector analysis, is just to get a sense of what the immediate impacts of some of these things would be. But I completely agree with Alan. It's all about the institutional infrastructure that it's created, which is going to be really hard to replicate. When the WTO has tried to do it, when other trade agreements have tried to do it, they've taken, if anything, decades to do that.
I think on Alan's point, I'd say a strong yes, and then perhaps a small but. I think the other aspect of the yes, that whole competitive environment, is competition and state aids. This has been an exceptionally effective regime for the UK because we tended to subsidise our industries less than our European competitors, and having some boundaries pretty professionally policed by the European Commission over the decades, and then changing UK competition, state aids, mergers, regulation essentially to conform with the European model, which proved to be more rigorous than the UK model we'd had previously. This is a massive plus. We will, of course, as and when we leave, have the opportunity to subsidize our companies, but we would be doing it against a background where our largest trading partner has much more countervailing power than we do. So even on the most basic transactional level, it's not clear that, say, deciding to subsidize a steel plant in the UK would actually get you anywhere. My small question mark is just, I think, trying to take sectoral recognition of professional qualifications forward has been worthwhile, but I think your point still stands because we're doing that in a context where hairdressers or accountants or whoever are part of a single market, and we are seeking to provide those benefits to them. So I'd agree with that. And just briefly on Ian's very good and extremely difficult point, I think we have to be explicit with people about the trade-offs. It depends how far people thought they were voting to leave the single market. I'm not an expert on this, but my finger in the air would be, I'm not sure people felt very strongly about the single market. They did perhaps feel more strongly about the migration aspects than about the European Court of Justice as an ultimate economic referee. But that is something we would have to be clear about. I think what people have to understand is the costs, the certain short-term and probable medium-term costs of moving away from a single market and customs union structure with all of the regulatory competitive environment we have at the moment. And the EEA model does give you one partial way of maintaining some of those benefits without being able to set the standards, and of course having to pay something into this machine to do that.
I think on the point about this being the institutions that are most important, I'm going to briefly touch on environmental things a second here, but in terms of the environment, that's entirely true. Having a shared framework with enforcement that it's essentially allowed progress in areas beyond trade, because you could bring in more stringent regulations on emissions or whatever, and the pushback wouldn't be as severe because all of their competitors within the European region would be subject to the same parameters and have the confidence that if someone was to undercut them, the Commission could get involved and that there was an effective arbitration mechanism in the form of the ECJ to hold them to account. And that allowed progress on the UK's environment and beyond to go much quicker than I think it would have gone otherwise. On the question of single market and customs union, one thing I'd say is that even if we remained in the single market and in a customs union, there would still potentially have to be border checks, because VAT doesn't fall under either of those. So currently we're part of the internal EU's VAT regime, but that's a fiscal policy, so that's outside of both. So it doesn't even completely solve the border issue. I'd also say that as they exist, we'd also be outside of CAP. We'd be outside of the common commercial policy, which would potentially give Liam Fox some hope in that situation. But there's also issues then in third country agreements don't immediately continue to apply even in an interim agreement that looks like that. So they all have to be replicated by March 2019. So there's problems there. And then also on accumulation still, because our customs union is effective for the people within it, but as Turkey finds out, not for those outside until it negotiates its own agreement, and if it then has provisions for accumulation. And I suppose my point is, and it's what I said earlier, there's trade-offs, and there's political price discovery insofar as I still don't know what the Brexit mandate was and what it means, and it seems to keep changing. So in a year's time, we could be in a much different place, but it's very hard to sort of put your finger in the air now and say this is what the people would accept and what they wouldn't. And all divergence is going to come at a cost. I mean, as I gave the example, importing chlorine chicken means border inspection posts on the Irish border. It means a hard Irish border. It means, as a DEFRA vet said to me, that we would no longer be able to export our sheep via Calais because it doesn't have the capacity to do it. We'd have to send it in by helicopter, instantly making it uncompetitive. So there are huge trade-offs, and I'm assuming they're going to eventually have to be confronted, or at least I'd hope so.
Okay, I had a very specific question for Swati, actually. So the title of this panel is Which Barriers Matter for the UK? And we've talked about different barriers in different sectors and industries and different sizes of companies. But I was wondering, Swati, could you talk about your research on trade barriers mattering to different regions of the UK in terms of who is going to be affected by these?
So let me start off with saying we've already heard a little bit of this discussion in the previous panel, and what they were trying to measure was to look at exports and imports coming from the EU into a particular region, and then trying to assess what the exposure to EU exports and imports of that region is. That's not quite what we're trying to do, because we're also trying to get a sense of how sensitive are you to getting hurt, because there might be the competition might be very different in different sectors. So we're accounting for that sort of substitutability, which is why that result could be different from what the basic exposure measures are. And in that sense, the sort of, I think both estimates are worth knowing, because what our estimates would tell you would be that, look, we think competition happens at the sectoral level. And once you've got the sectoral shocks from what happens at the national level to a particular sector, say the auto industry, and then let's look at, since Sunderland is so exposed to the auto industry, what does that mean for Sunderland? Taking into account also that, there's Sunderland, there's also other manufacturers, car manufacturers in Germany, elsewhere. So all of those features are going to come into place. And then what we find is that it's actually in terms of sort of just absolute magnitudes of who's going to be hurt. And so if you look at where is the percentage drop in GDP, which region, where is it going to be higher? And overwhelmingly what we find is it's going to be London and the southeast, which is going to be more hit. But this is, remember, a very, very sort of immediate impact assessment. This is saying today, based on what the employment shares in London is versus Sunderland is, London is going to be more hurt. But that's not saying that Sunderland is going to be better off. Sunderland also sees a negative. In all regions, for the non-oil economy, we see a negative. And what's really sort of troublesome, which is where I completely agree with what Phil talked about, is that places like London recover much faster. That's been the experience in the financial crisis. These tend to be much more sort of resilient economies compared to, say, the economy in Hull or Crawley, which are going to find it much harder to recover from that sort of shock. So in that sense, I don't think we're really in disagreement. It's just a matter of how you think about the exposure.
Wonderful. Okay, I'm going to offer, we've run out of time, so I'm going to offer each panelist to have a sort of one-sentence summary, and then we can have a break. Sam?
Diversion comes at a cost, and I'm still not entirely sure the UK's prepared to pay it.
investments are made by real people and companies who do not like uncertainty. So the perception of the UK's future position will have a significant chilling effect on decision-making and investment in this country.
I have nothing to add to that, so I'll answer Ian's question, which is that I don't think this is a Ramona stance to take, for the reason that after last year, this very conference, when John Curtis showed his estimates for what people, when you ask people, do you want free trade or not, do you want immigration controls or not, 90% wanted free trade. With the EU, 70% wanted immigration controls. So do I interpret that as that people actually value free trade more than immigration? I think it's very hard. We're all taking a punt on what people are thinking. So in that sense, given that there wasn't a plan B that was mentioned, which explicitly said we're going to be out of the single market, I don't think there's actually a political moral justification that that means we have to leave the single market.
Swati, Martin, Sam, thank you very much.